makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, in for Francine Lacqua. Here's what's coming up on today's program. A hawkish skip, stocks falling and bond yields rising as the dollar climbs as the Fed signals rates will stay higher for longer.
We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
And on a knife's edge, softer than expected inflation raises questions over whether the Bank of England will hike for a 15th consecutive time. The pound weakens for a second day. Plus, coming up on Bloomberg UK, Prime Minister Rishi Sunak faces a backlash after pivoting away from key elements of his government's green agenda, but denies that it's a political move. We'll have all the details and all of the analysis you don't want to miss. Let's kick off the show by taking a look at the European markets because, again, you are seeing red across the screen. This is very, very normal, given that perhaps we're calling this a little bit of a Fed hangover, if you will. Let me walk you through it, though, because you do start to see some real pain really kind of focused into the French index there, down about 0.9%. But take a look at the FTSE 100, actually underperforming, which is interesting because it is still down about 0.4%. But again, the winners of the last couple of days, which, by the way, is on the continent, not here, seem to be the ones that are taking the biggest hit. That is the same dynamic you saw in the U.S. session as well. Your winners of the last few sessions taking the biggest hit, which tells me that technicals, retracements, that is what is playing a role. But again, that's just the equity story. The bond market story also incredibly relevant, especially as we see Treasury curves at cycle highs. And that's really what you need to know about all of these lines, all going into one direction, up. And that is crucial as we talk about just how long the Fed is going to stay at this higher rate level. What's interesting, though, is that cuts have now been priced in for later throughout, not just next year, but the years that follow. And that at its core is what the UK now has to think about as well. Inflation, finding a little bit of relief. That's what this white line is all about. So whereas yields are still climbing, inflation is coming down. But the question is how much? The question as well is not just about rate hikes or rate holds. It's about quantitative tightening, those active bond sales at the core of today's decision. Remember, the Bank of England was the first to start tackling the quantitative tightening agenda. Now they're saying, well, look, not only are we going to let them roll off the balance sheet, we're actively going to sell them on the bond market. How disruptive is it? We don't quite know yet. And that, of course, is going to be a question that has repercussions across Europe, which brings me to some breaking headlines that we're getting right now. The Norges Bank raising their benchmark interest rate decision to 4.25%. Now, the estimate was also 4.25%. It looks like they're seeing only one more rate hike, likely in December. Now, here's why this matters, because, of course, already you are seeing strength in the Norwegian krone against the euro. But the other piece of the equation is simply that this is an oil-based economy. Compare this to what you're seeing in the Riksbank as well, where they're really trying to tackle inflation while also monitoring the kind of pain in the real estate sector. The Norges Bank doesn't have that problem. And for that reason, perhaps might be a little bit more bullish towards the Norwegian krona for that reason. That's going to be crucial as we talk about the read-through around the world. To what extent are the oil prices going to be affecting monetary policy? And that's where I want to go when we talk about the Federal Reserve. Bloomberg's Valerie Teitel joins us now. Valerie, there's a lot to talk about with what the Fed really has to revisit, wages, oil, etc. Is the inflation monster gone now?
Well, there has been a lot of good progress, and that's good for the Fed's inflation fight. And I want to say that in yesterday's press conference, one thing we didn't necessarily hear from Powell was a need to see below-trend growth in order to trust this progress on inflation. I think that's a big question for markets now. Now that they have given that substantial upgrade to growth, we saw it in their projections. It didn't necessarily entail that inflation would have a hard time getting back to target. So could we exactly see a cut from the Fed even before this economy turns, if inflation is in fact maintaining this downward trend, is the question that markets are dealing with.
But talk to us about the cuts then, because when you look at the changes in the market pricing here, the idea that cuts are now further out into the not just this year, but the next few couple of years, tells me that it's perhaps scary, not now, but scary down the road. How worried should we be about a faster deceleration than expected?
Well, look, we're clearly not dealing with that at the moment right now. The U.S. economy is very strong. As we saw in the projections yesterday, they had to upgrade the U.S. Economic growth this year to nearly double what it was previously in June. And Powell seems to be giving this message that as long as the economy is going well, there is no need to cut. We are still seeing progress on inflation. We are still seeing the labor market weaken. So there really isn't any need to move to I guess, a easing bias until we see growth turnaround.
A lot to digest there, of course. Bloomberg's Valerie Titel all over the Federal Reserve decision, which already you can see having a little bit of a hangover effect. We'll get a little bit more insight. Joining us now, Eddie Vanderwalt. We begged him to stick with us because they just can't get enough of Eddie. Joining us now from our Markets Live team there. Eddie, talk to us a little bit about this market reaction, because when you're looking at the yield space, when you're looking at the currency market, this really does feel like a Fed hangover. What are the markets missing right now?
Yeah, a little bit, but I do think that the market's also starting to move on to the the whole cluster of other central banks that we have. It's starting to get exciting, and it is definitely an FX day, right? I think it's definitely going to be all about how the currency reactions. Well, sure, we'll see some reaction in the short end for the US, but I think that kind of move is now done. What we're looking for is for the Norwegian kroner, where they're talking about intervention or hedging of part of their FX reserves, which is really just a little bit of currency intervention by another name. And then the Swiss franc, of course, where they delivered a surprise hold. And I think all of these, if you take it together, what I'm looking at is a market where we're seeing more policy divergence globally, where we're seeing more central banks taking a look at their own economies and saying we've got to act accordingly, and not just take what the Fed does and plug it into our models. Yeah,
the terminal rate gets really interesting here, and I want to bring a quick graphic here because one of the big numbers we're monitoring is going to be not 5.25%, which is what the Fed has increased it to, but 5.5% from 5.2%, but the 2024 rate projections at 5.1%. So you are still seeing this higher for longer narrative that we are watching going into 2024. I think what I'm so confused about here is that when you have these kind of cross-asset fluctuations, currents, whatever you want to do, you're the one who taught me this. The idea that, at the end of the day, in points of crisis, correlations can go to either 1 or to 0, all assets moving at the same time. Right now, the oil market and the bond market are telling you two very different stories about resilience and what resilient looks like in 12 months' time. What market do you pay attention to?
Wow, I clearly taught you too well, because I almost don't know how to answer that question, Kriti. Look, we're in a very difficult moment in the world economy, and I think the oil price definitely has a big input into all of that. I think when we look at what the bond market is pricing and what we're looking, what traders are pricing for future cuts in the US, what they're talking about is perhaps an economy that is still seeing inflation, more inflation coming through via the oil market, and that the Fed will be forced into hiking more. Because I think if there's one mistake that the Fed will not like to repeat, it's to say that if there is a spike in inflation this time around, it is transitory. I think this time, if they do see oil prices feeding through into the rest of the economy and we see a hot inflation again, they will hike, and they will hike aggressively. And that risks tanking the economy. So you've got this risk of, the plane coming in for a soft landing, it's speeding up, and you getting a no landing, and therefore, pulling back on the throttle and getting a crash. And I think that's what the market is more and more starting to position for.
Quite a vivid nightmare you just painted us, didn't you? Let's talk about the oil story, though, because at your core, you're a commodities guy.
I am a commodities guy.
Let's talk oil a little bit more, because, again, to your point, if you are forecasting this kind of nightmare plane crash, if you will, the first non-recession-proof asset is going to be oil, right? And we just had a guest on Bloomberg Radio say, look, he's actually bullish on European energy for the exact opposite reason, because they're investing in, say, long-term energy. I'm going to bring it back to the commodity story, though, which is how much exposure do you want to commodities right now as a sign of economic resilience, even when it isn't recession-proof?
Yeah, the commodity story is so interesting, because I think, it's still very much a play on a comeback in China. Are we going to see a comeback in China? I'm not sure that we are. But, if you're looking towards oil prices, OPEC is clearly signaling that they are willing to keep the prices higher for, higher for longer, if you like, right? They're refusing to pump into the strength that we're seeing in the market. I would have thought they wanted to take market share back if we get close to $100 a barrel. It doesn't seem like they are. Now, guessing what OPEC is going to do in a closed room is a bit like guessing what a central bank is going to do. You can look at the inputs, but you can't, guess at you can only guess at the ultimate decision. And I think that is the problem now, that and because it is such a big input into the world economy and into other people's models, it kind of throws everything else into disarray.
But that's what you hit the nail on the head, this idea that you kind of have to predict what the Saudis and their counterparts are going to be thinking, which, to your point, is kind of impossible to do to some extent, which again brings me back to, do you foresee some sort of pullback in the actual investment interest? Do you see open interest collapse to eliminate exposure to that?
Yeah, so if you can't predict it, you can't trade it, right?
Yeah.
If you don't know how to price it, if there's no modeling, and more, it is not even OPEC and Russia, it's more and more just the Saudis, right? Who's carrying the market alone. And at some point, they could just turn around and say, hang on a second, we don't want to do that anymore. We're quite happy with the prices that we're getting right now, so maybe we do pump into strength. But one thing about the oil market is we're not seeing that massive recovery in US shale. So I think OPEC probably feels a little bit more comfortable in what it is doing, because it's not giving away too much market share to the rest of the world. Because, so I think there is a risk that they test the market, see how far they can go. But like I said, that's a black box, right? It's really hard to predict.
The days of buying a bunch of commodities, throwing them in a basket, and knowing it's a sure thing are certainly over. Bloomberg's Eddie Vanderwalt, we thank you as always. Now, coming up on the program, it's a cliffhanger. We turn our attention to what to expect from the Bank of England rate decision today. That conversation next. This is Bloomberg. Welcome back to The Pulse. I'm Kriti Gupta in for Francine Lacqua. Joining us now for a look ahead to the Bank of England rate decision coming up at midday UK time. Bloomberg's UK correspondent Lizzie Burden standing outside the Bank of England. Lizzie, let's start off with how yesterday's inflation print changes the picture.
Well, Kriti, there are some who would argue that the last time the Bank of England surprised everyone was back in June with a 50 basis point hike, and that came after some inflation data that surprised to the upside. Well, yesterday we got a pleasant surprise at the headline level, the core level and the services level. So maybe we should expect a hold today, but that would be to suggest that the Bank of England merely reacts to whatever happened yesterday. Well, that's what Nomura and Goldman Sachs reckon will happen. They changed their call off the back of that CPI print yesterday, and indeed the markets pared back their bets on the risk of a quarter point hike today. Before the print, they thought it was going to be about 90%. Now we're on the knife edge, 50-50. But the thorn in the Bank of England's side is really going to be that hot wage growth that we've seen in the UK. I was just speaking to Kitty Usher from the Institute of Directors. She says not to mind that so much because it's a lagging indicator. So echoing the argument of the Dove on the Monetary Policy Committee, Swati Dhingra, but it'd be interesting to see whether the guidance that accompanies the decision reflects that, whether there's more of an emphasis on forward-looking indicators like the PMIs. But in any case, markets reckon they fully price another hike from the Bank of England. Whether it's today or whether it comes in the future will be interesting to see in the commentary.
Well, you mentioned that markets are actually pricing stuff in already, even though on the surface it does look like a coin toss decision. What is the fallout in the pound and for the gilts?
Well, after the inflation data yesterday, you've seen the pound sinking. And the last time I looked, Kriti, it was at $1.23. Nomura actually says that it could go to $1.18 if you get a hold and if you get dovish comms as well. Look, the pound has had a great start to the year in the sense that it's been boosted by the higher rates narrative. But in the second half of the year, weak growth really has weighed on sterling. This is a difficult turning point for the Bank of England, whether the pause comes now or later. and therefore we're likely to see volatility. Volatility also in gilt, because of course we are expecting an announcement on QT, quantitative tightening as well. The groundwork's been laid for this. The Deputy Governor, Dave Ramsden's told us it's coming. He wants to restock the arsenal in case of another crisis. And the expectation is that this pace of asset sales, currently £80 billion a year, is going to be ramped up to about £90 billion, £100 billion a year. If it's more than that, you could see some upset in the gilt market.
From outside of the Bank of England, Bloomberg UK correspondent Lizzie Burden talking to us all things BOE. We thank you as always. Let's bring in Anna Andrade of Bloomberg Economics for a little bit more analysis on that topic. Anna, I want to start where Lizzie left off on these active sales in the bond market. QT at its core, what is the number that spooks the market?
Hi, good morning. So I think anything above 100 billion, as Lizzie said, will spook the market. And already, I mean, the Bank of England has been very clear that it wants QT to run kind of in a smoothly in the background, in a predictable manner, and so that it doesn't have like a lot of impact in tightening financial conditions. But we've heard from Andrew Bailey, I think a year ago, and we've heard from Ben Broadbent as well, not too long ago, that anything above 100 billion, might create some, market disturbances. So I think there's definitely room for increase. The 80 billion, our view is that they will increase to 90 billion, the QT target, and that will be mostly driven by higher redemptions falling over the next year, rather than a pickup in active sales. But anything beyond that kind of, it runs the risks of transmitting a signal that the BOE really doesn't want to.
What is the logic there, though? And forgive me, I'm American. This is how we do things. When you look at asset prices and the idea that perhaps the Federal Reserve or any central bank can really pull kind of the rug from under asset prices broadly, for a while that was considered a positive for the Federal Reserve. Jay Powell wanted to do that, to really tackle asset price inflation. So why would the BOE want this to be a smooth process? Isn't disruption into a bond market and an equity market really hitting the heart of inflation a bit harder?
I would say that, QT, the dynamics around QT are very different to the dynamics around QE. So for a long time, we had quantitative easing, so asset purchases kind of acting as the marginal tool. Interest rates hit the lower bound. So, QE was really kind of doing the work in terms of signaling like the commodity stance. And it's now known that QE was more effective when it was there were some surprise announcements and when it acted at times of high market, disturbance. But and QE at the time really eased financial conditions a lot. But the Bank of England doesn't want the symmetrical effect to happen with QT, because it now has room in the with the interest rate to really kind of steer markets and to transmit a signal of monetary policy with the interest rate, and doesn't want QT to kind of get in the way of that.
So what could get in the way of this? Because, I mean, there seems to be the fact that we're even talking about a coin toss decision for the BOE seems surprising to me, when it feels like of all the central banks in the world, it's still the Bank of England that has the most work to do. What is the case for a hold?
So, I mean, the case for a hold, and I think, yesterday's CPI print was, crucial for that. It really increased the uncertainty going into this meeting. The case for a hold is that the BOE is monitoring 3 indicators: activity, wage, and inflation. And with yesterday's print, 2 of those indicators have come below its forecast. And its reaction function has always been that any upside surprises would lead to further tightening. But now you have activity kind of coming below its forecast, and also inflation coming below its forecast. So the case is like, okay, 2 out of 3 indicators, are below its forecast, so there's reasons to hold. I think, as you said, it's a coin toss. It's really hard to know. The BOE has surprised us in the past. I ultimately think we stick to our call of a 25 basis points today, because I ultimately think that the reality of the data and the experience of the past 6 months is really going to push the BOE into a hike. It's just that wage growth is too high, the level of inflation is too high. So we have inflation at 7%. When the ECB or the Fed kind of hinted at a pause, or the ECB kind of gave a dovish hype yesterday, inflation there was at 5%. 7%. You know, 7% inflation is still too high, and the risk to inflation expectations is high in the UK.
A really interesting idea that the idea of a hold almost puts a lot of faith in that a lag is actually going to have a bigger effect. Anna Andrade of Bloomberg Economics, we thank you as always for your analysis. Coming up on the program, we stick with the UK. Perhaps a little bit more fun news. Tottenham Hotspur's chairman says he's open to selling a stake in the London Football Club. We'll bring you our exclusive interview with Daniel Levy next. This is Bloomberg.
My answer to that question has always been the same for 23 years. We have 30,000 shareholders who own approximately 13.5%. We run this club as if it's a public company. If anyone wants to make a serious proposition to the board of Tottenham, we will consider it along with our advisors. And if we felt it was in the interest of the club, we would be open to anything.
Tottenham Hotspur chairman Daniel Levy speaking exclusively to Bloomberg's Jonathan Farrar. I want to very quickly bring you a headline here. The yen's real effective exchange rate falling to the lowest in 53 years. You're looking at dollar yen right now. 148.16 is what we'll call it. Of course, we know the BOJ will be coming tomorrow. Yen very much on the agenda. We'll, of course, give you more context in the hours ahead. For now, more context on the UK coming up.